back to this week's market update. Today is Monday, May 18th, 2026, and we'll jump right in. Looking at last week's market performance, stocks finished little change as inflation data came in hot and geopolitical tensions continued to weigh on investor sentiment. Equities moved higher earlier in the week and briefly hit new all-time highs on Thursday before a sell-off on Friday. As of Friday, May 15th, the S&P 500 was up a very modest 0.13%, while the Nasdaq was down 0.08%, and the Dow Jones Industrial Average fell 0.17% last week. Moving into our economic data from last week, April CPI rose to 3.8% year over year, with core inflation increasing at a much more modest 2.8% in April here. On a monthly basis, headline prices were up 0.6%, core prices up 0.4%. And when you look at the categories, energy continues to be the main inflationary category. So energy as a whole was up almost 18% from a year ago. When you break that down further, energy commodities have really been the primary driver of this, with all of the geopolitical risks and events going on. They were up 29% from a year ago. More specifically, fuel oil alone was up 54% from a year ago. So we can see definitely seeing some action in energy prices as the events in the Middle East have affected the supply of energy throughout the world. Looking at some of the other categories here, you can see new and used vehicles have had much more moderate inflation rates. New vehicles up just 0.2% from a year ago. Used vehicles actually down 2.7% from a year ago. Shelter did rise a hotter 0.6% in the month, but moderated to a 3.3% inflation rate there. Transportation services, lastly here, did rise to 4.3% annual inflation, and that obviously has been affected by higher energy prices as well. Another important aspect of this month's inflationary print is that it marked a potential turning point in real wage dynamics. More specifically, wage growth was just 3.6% in April, while CPI, as we just took a look at, was 3.8%. So this is the first time in 3 years since inflation has outpaced income growth. All in all, this month's data confirmed that inflation risks are rising and have the potential to snowball into a larger issue in the months ahead. We'll take a look at the PPI as well as retail sales and how those have had an impact on interest rate expectations in the next slides. April's producer price index surprised to the upside, with annual wholesale inflation rising to 6%, pretty big jump from the prior month, and it was also the hottest rate since December of 2022. Core PPI was also elevated at 4.4%, and then on a monthly basis, we had prices rise 1.4% on a headline basis. By category, both goods and services saw pretty hot inflation. Goods prices were up 2% in the month, largely driven by a 7.8% increase in energy costs. Services were up 1.2% in the month, also driven by energy costs as well, with transportation and warehousing up 5% in the month of April. Producer prices are especially important as they do flow through to consumer prices within a few months. So with rising producer prices, we're likely to see a rising CPI in the coming months. Moving along in our week, retail sales grew slower than expected in April, rising 0.5% in the month and 4.9% year over year. The headline strength was distorted by energy prices, similar to the CPI and PPI that we just took a look at, with gas station sales leading the increase, up almost 21% from a year ago. Excluding gas station sales, retail sales were growing at a much more moderate 3.7% annual pace. All in all, we're starting to see a heavier impact of the supply side constraints in the Middle East on the energy markets, and that's starting to flow through to inflation, retail sales, many other macro data points. And we'll take a look at how interest rate expectations have been shifting in the next slide. Last but not least, as I mentioned, just taking a quick look at how interest rate expectations have shifted in recent weeks. Currently, markets are pricing in just about a 51% chance of no interest rate changes by year end, a 0.4% chance of an interest rate cut by year end, which was previously at a much higher probability. And then on the contrary, we have about a 48.7% chance of one or more interest rate cuts by year end, which would be to combat rising inflationary pressures. Although this comes at a really uncertain time as the Fed balances these higher prices alongside below average labor market growth and some different structural dynamics, including labor market pressures from the growing adoption of AI. So, a very dynamic macro landscape, and you can see how the interest rate expectations in futures markets reflect that outlook. That concludes this week's market update. We really appreciate you tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.